Hey guys, have a ton of new information for you this week. I'll be covering the weekly numbers for Branford, Guilford, and Madison for the second week of April. Also going over the first quarter results, January, February, and March for 2020 versus 2019 and 18. And also giving you my analysis of what I think the second and third quarter is going to look like in real estate. So let's get right down to it. Madison, 7 new listings, 11 under contract, and 3 closed. Guilford, 9 new listings, 7 under contract, 7 closed. And Branford, 10 new listings, 11 under contract, and 5 closed. So as we can see, real estate is alive and well and happening every day. Properties are coming on the market and going on deposit. However, since we are in April, under normal circumstances, this would be the spring market and we would be seeing much higher activity. Given that we are in a pandemic, although real estate is still happening, we are starting to see a softening in numbers that we would normally expect to see. This is totally understandable under the circumstances, so we're going to continue to watch this and monitor it so we can kind of see what's happening. Wanted to review the first quarter numbers. So this covers January, February, and March of 2020 versus 2019 and 2018. So the market performed very consistently in terms of prices, in terms of units sold. Branford and Guilford were pretty much even, and the only town that saw a decrease was Madison, and they saw a 9% decrease in the number of houses sold. So that's the first quarter numbers. We're now in the second quarter because that's April, May, and June, so we're going to see how this unfolds. I wanted to discuss what I see and what I think is going to happen in the second and third quarter. So I believe the second quarter is going to be very interesting, that we're going to see softening of the numbers, but it's more going to be in activity. We would see a lot more activity than what we're currently seeing. Right now we see no downward pressure on pricing because there's a low inventory. And what I can tell you right now, if you're a seller and you need to sell your house or you want to sell your house, this is a good market because properties, as long as they're priced properly based on their condition and location, if they go on the market, they are going under contract quickly and they are selling for very close to their listing price. Obviously, if you've overpriced your property, you're not going to experience that kind of an activity. What do I see happening? One of the things I wanted to cover is how this pandemic in 2020 is very different from what happened in the financial crisis in 2008, 9, and 10. So the underlying fundamentals of the market are completely different. In 2008, there were a couple of things that were going on. Number one, you had a very rapid appreciation in home prices. You had very low standards for mortgages, and pretty much anybody that wanted a mortgage could get one, whether they had a sketchy work history, a bad credit score, or quite frankly, could even afford to buy the house. The third thing that was happening, and this is another critical fundamental of the market, is because there was such a rapid appreciation in price, many people were refinancing and cashing out on their equity. So those were the underlying fundamentals. So when the financial crash happened, you had a lot of people that had no equity in their home. One, because of the low standards in mortgage, so you could basically buy a house with no money down, or people had cashed out their equity because they had refinanced. Let's go to 2020 now. What we have seen in the 5-6 years preceding 2020 is we have had a very moderate and measured incremental increase in property values. We have had much higher standards for mortgages, and you had to have a job, you had to be able to afford the house, you had to have a good credit score. So people that actually have their mortgages are in a better financial position than the people back in 2008. The other thing that's critically important is very few people have refinanced their home and cashed out their equity. And the third thing that's really important is people by and large have equity in their home. So an example of what I'm talking about is, let's say you own a house and it's worth $450,000 and you have about $150,000 of equity in it. And let's say there's some downward pressure on prices. So you can't sell it for $450,000, but you can sell it for $425,000, $25,000 less than you would like. What that means is if you need to sell, you're going to sell, because you're going to walk away with $125,000 in equity. You're not going to foreclose, because if you foreclose, you're going to be leaving $150,000 worth of equity on the table. So these are the underlying fundamentals that really make what's happening now in a pandemic completely different from what happened in 2008. We're going to continue to monitor the market. We expect that the second quarter is going to be interesting, and that the numbers aren't going to be pretty, but more so in activity than in foreclosures or downward pressure on price. And then from everything I'm reading, what's being anticipated is a V recovery, so that the second quarter is going to be not pretty, and then it's going to rebound once everything normalizes, because at some point we're going to be on the other side of it, and people that are furloughed will go back to work, people that are unemployed will be able to get a job again, people will be qualifying for mortgages again, and sellers will not be afraid to put their house on the market because of all of the health concerns that are currently present. So that's my market update for the week. If you're anything like me, you're looking forward to getting on the other side of this and coming out of quarantine. So be well, be safe, be happy, and I'll talk to you soon. Bye-bye.